that wait for the decline, and when the decline comes, you need to be a buyer. Having said that, the management of Happiest Minds now joins us, Mr. Venkatraman, Managing Director and CFO of Happiest Mind Technologies, and we've got Joseph, of course, Co-Chairman and CEO of Happiest Minds Technologies. They both join us. Good morning, gentlemen. Thank you for joining us. Now, PAT has dropped over 32% sequentially, and EBITDA is down 6%. Can you break it down for us? Cost pressures, one-offs, what transpired for the quarter gone by?
We have had a very good growth year, except that in this last quarter that we had a bad debt of about 12.5 crores. That was a one-off event. Adjust for that, our operating margin has also grown, whether it is quarter over quarter and year over year as well. So EBITDA, the same bad debt flows down to EBITDA, and you will see the same impact in our EBITDA as well. But be that as it may, if you look at the year EBITDA, we are at about 21.4%. Adjusted for that bad debt, it would be 21.9 or 22%. We had given you a guidance of 20 to 22% for the year. So absolutely keeping in line with that. And I should tell you, this is the 18th quarter of growth and meeting guidance as far as EBITDA is concerned and the profitability measure is concerned. When you come below that onto PAT, you allured to PAT. There are quite a bit of noises in terms of valuation, accounting, amortization of goodwill and everything. We have removed all those accounting noises and given you adjusted PAT. Adjusted PAT is at about 10% for the quarter, and it's about 11.5% for the year. So effectively, the margin drop that you see is because of the business mix. It is the investments that we have made in GBS and the new sales team, which is about 40 crores, and also the bad debt that I talked about. So if you adjust for all of that, we should be thereabouts in the range of about 12.5% in terms of PAT for the year, which doesn't show too much of cost pressures on the system. But yes, the focus will be to make sure that we improve on all these margin metrics while also keeping an eye on that growth, which we are targeting a double-digit growth this year.
BFSI contributes over 26% of the revenue. Is this vertical driving growth for you? And do you expect momentum to continue, Joseph?
Yeah, so if you look at the BFSI performance, especially year on year, it has grown significantly, and there are and both organic and inorganic growth have contributed. As you know, both Pure Software and Aureus have a high concentration of BFSI revenues. Aureus more in insurance and Pure Software more in the banking space, which was the reason why we made both of those acquisitions. So they've contributed quite a bit to the growth you see. Outside of that, we are seeing good traction in two verticals, in BFSI and the healthcare and life sciences. And as we speak, the pipeline from BFSI customers is quite positive and promising. And we expect this momentum to continue into FY26.
Right. Joseph, high-tech and edutech have shrunk on a sequential basis. Are these temporary shifts or signs of structural slowdown that you're witnessing?
So if you look at edtech, and in the past interactions as well, I've been saying that that's a segment that's going through quite a bit of a churn. Our revenues were concentrated a little bit more in the higher ed space and less. And the second segment was K-12. We didn't have as much in the workforce development, and we're seeing that that's the segment within edtech that's doing well. And we're trying to pivot our go-to-market and our offerings towards the workforce development to overcome, the huge pressures that we are seeing in the higher ed space. So I think during this year, hopefully our strategy will play out and we'll see this stabilizing. On the high-tech, in the high-tech segment, what has really hit us is that bad debt that Venkat talked about. As a result, we had to stop working with that customer. It was a pretty large customer. And that is the impact that you've seen on a quarter-on-quarter basis. Going forward, we wouldn't be seeing this impact, and I expect that the high-tech segment should show growth in the current upcoming quarter.
Right. Joseph, revenue from Americas has also dipped while the rest of the world and APAC have grown. Is client concentration a concern?
I think the major impact actually out here is the customer that I talked about, which resulted in the provision for bad debt and impacted our margins this quarter. That customer, as I said, we had to stop working with them. It was a significant size actually. It would have been in our top 7 or 8 top 10 customers, by quarterly revenue. And that customer is based out of the North America region, and that's what has impacted North America on a quarter-on-quarter basis. And if you look at the share of North America, that has come down because the acquisitions that we made, they have a higher concentration of revenues in APAC and also in Africa. And in a way, I think that was one of the positives of these two acquisitions, because they gave us a diversification of our revenue and reduced our reliance on North America as a geo.
So when that average revenue per active customer is improved, are clients spending more? Are there specific accounts driving this?
There are two reasons for this. We have always said that we'll focus on getting that number to $1 million. Last year, it was at about $794,000. We have ended this year with about $917,000. It's got nothing to do with client spending more. It's more of the way we are trying to focus on the high potential large accounts and focusing to go deeper. And this is in line with our strategy of, land and expand or pursue high potential accounts, PE accounts and the like.
Okay. So Joseph, one of the key wins involves building an end-to-end user platform using generative AI. What is the broader demand outlook there?
If you look at generative AI, last year, the focus was more on educating customers, working with them to identify use cases and build POCs to validate those use cases. As we move into the next fiscal year, we are seeing that customers are beginning to start larger projects and implementation. The other thing that we are seeing is customers are taking a GenAI first approach. Instead of bolting GenAI onto existing products, they're looking at how the new applications and platforms that they're building, how can GenAI be the interface and drive the rest of the architecture using GenAI. The other trend that we're seeing is increasing use of agentic AI to automate some of the processes and interactions.
Right. Joseph, also walk us through some of the notable large deals that you've seen this quarter, and any of them, are they multi-year or annuity in nature?
During the quarter, we had quite a few promising wins. One of them was in the learning space, where we're already at $1 million in revenue. We also were able to close a customer in the PIMCore space, which is again a land and expand for us. The initial deal size itself is around $500,000, and once we finish that, as we work on that implementation, we expect to expand that and make it into a $1 million customer. This is in the retail space. In the healthcare space, we've closed a customer. We're doing a discovery exercise to modernize their application and platforms, which should lead to huge downstream revenues, with a customer in the media and entertainment space who are based out of Mexico but have theaters across the world. We've again done a discovery exercise, and we've submitted an SOW that would be a couple of millions of dollars. As we can see, it cuts across multiple verticals, and in the BFSI space for one of the large banks for their APAC region, because this is a global multinational bank, we're able to win an RFP, and we've started implementation. The last one I'd like to call out is an insurance customer in US, and we closed that deal, just on 30th or 31st of December. That's again taken off really well.
Right. Venkat, lastly, given the Q4 softness, what kind of growth trajectory are you targeting for the full year, both in revenue as well as margins?
So we have talked about growth in terms of double-digit growth for the next year. That's what we talked about in the press conference a few weeks back. So we are holding on to that. The situation, the economic situation is evolving, but we are seeing good opportunities, decent pipeline, good pipeline. In fact, we are also seeing our acquired companies doing better than what we thought earlier they would do. So all of this put together is giving us that confidence. As far as margins are concerned, on the EBITDA front, we are trying to hold on to the same 20 to 22% that I talked about earlier, but the focus will be to improve on that as we go forward.
Gentlemen, appreciate your time. Thank you for joining us. Markets are, I wouldn't say that they are cracking, but